Good morning, everyone. Thanks for joining us again for our TVFCU mortgage webinar seminar on this Thursday morning before Memorial Day weekend. Great having you here. Also have a couple of friends here. Kasey Lewis is joining us and Janet Sherman. Good morning. How's it going, Kasey, Janet?
Good
Morning.
morning.
Good, good. Well, I brought Kasey and Janet in today. They are mortgage originators here with TVFCU. And we're going to be talking about some key terms in the mortgage business about what you might run across when you're potentially doing a mortgage loan, hopefully with TVFCU. But first off, we're going to introduce ourselves. Most of you, if you've joined this webinar in the past, you recognize me. I'm Bryan Fryar, the mortgage sales manager here at TVFCU. I've been at TVFCU for about 14 years, been in the mortgage business about 25 years, roughly 24, 25 years. Had experience in origination, management, et cetera, in the mortgage field. So I brought in Kasey. Kasey, tell us a little bit about yourself.
My name's Kasey Lewis. I've been with Tennessee Valley for a little over a year and a half now. I've been in the credit union industry for about 6 years, and specifically mortgages for about 4 now, and loving every minute of it. Originally from Tampa, Florida, and moved up to Chattanooga a little over a year and a half ago as well.
All right, great to have you here. We're glad Kasey came on board with us a little over a year ago. Like a lot of people in the Chattanooga area, we have a lot of people moving this area, and I know Kasey really likes the Chattanooga area. So glad to have him here with us. And Janet, glad to see Janet here. Janet, tell us a little bit about yourself.
Hi there. Thanks for having me. I am a mortgage originator here at TVFCU. I've been here almost 14 years. Seen a lot of different things, so it's that's really good. I have been in the banking industry for 23 plus years. Prior to that, I was a nurse, believe it or not. But I love being in the Chattanooga area. I'm originally from Upper East Tennessee and Jonesboro, Tennessee, and but I love Chattanooga and just really happy to be here.
Great to have you here, both of you here with us today. I know you all, both have a wealth of experience and knowledge. So we're going to put our heads together today, and we're going to kind of go over some key terms. We also, towards the end, we're going to answer some questions that have been submitted for everyone that's here with us today. So we'll try to start and knock some of these out. I know Janet and Kasey, we talked earlier, so we've got some of these terms, and each one of you kind of want to go over kind of a little bit about what these are, what this means, what people do in our industry, and what they do here at TVFCU. So we're going to get started. Janet, tell us what a mortgage originator, a mortgage loan officer is, and what they do. You and Kasey both are mortgage originators. What do you guys do?
Yeah. Well, we are your first point of contact and possibly your last point of contact. We follow you throughout the entire process, but our first initial role is to meet you and discuss your options, discuss your needs, what your plans are, and then at some point when you're ready, we can actually get you pre-qualified, and then we will be with you throughout the entire process because this may be totally new for you. And we are your point of contact to answer your questions. You're not in this alone, and so we will take your application, get you pre-qualified, help you determine what you can and cannot afford, what you may need to do to prepare for a better purchase in the future. There's a lot of decisions to be made, and that's what we do, is help you with that process. We don't tell you what to do, but we guide you through the process.
Yeah. You basically let them know what programs are available, what they might qualify for, a borrower can, and discuss with them, what their options are, and basically kind of an advocate. I mean, you work for the credit union, but you're also working with our members and borrowers to try to put them in the best possible program or scenario for them. So good.
Right.
Good explanation of what a mortgage originator, mortgage loan officer, MLO, loan officer, originator, all different names we use in this industry. So you'll hear a lot of different things if you're working with TVFC or any mortgage originator. You had mentioned also, Janet, about pre-qualification. I know I talk about this a lot when it comes to purchasing and a lot of these webinars. Just real quick, what's pre-qualification?
Well, that is a very, very important step that will help you determine a realistic budget for the house you're wanting to purchase. It also shows your buyer and your realtor that your true intent to proceed, that you're not just kicking tires to see, what to do. Um, it helps you determine what do you need to work on if you're not
Mhm.
quite there yet. So that's what pre-qualification will help you determine. So it's very important to get pre-qualified if you're truly intent on purchasing a home.
Yeah, especially in this market. It's been this way for a while too. The limited inventory. Sellers want to make sure you are serious, and you want to make sure you've been
Hmm.
pre-qualified and you've talked to a lender. And I know on pre-qualifications, it's not going to be the whole loan package that's going to be decisioned. It's going to be your scenario, your application, your credit report. So it's just a quick look up. Hey, based on the information you put on this application and what we see on your credit, looks like you could be able to possibly purchase this property. So.
Hmm.
Um, Something Janet also mentioned, and Kasey, I'll let you kind of answer this one. What is they call it in the business, we call it URLA, application, or 1003. What are those?
Yeah, so kind of like Janet and you have touched on. So initially, you're going to fill out that URLA, which is your universal residential loan application. So you're going to go over all of your information from your name, your employment information. That's where you'll list assets, any real estate owned. And that kind of paints the picture for your loan officer as well as your processor down the line, your underwriter, and your closer eventually. So that URLA is really going to be kind of almost your storybook on your loan application in terms of all of your information kind of being encompassed in one document.
Yeah, and I know, being since I've been in the business since 1997, they always use the same URLA 1003 applications, all the same thing. They use the same one. I believe it was last year we had a huge change in the mortgage industry, and I think the CFPB and HUD and all them had been working on application over the past few years, and finally determined what they were going to make those changes, and that went into effect. I want to say it was about a year ago. This time a year ago, memory serves me correct. That application changed quite a bit. There were some changes made on the application to put email addresses, cell phones, things like that, demographic changes. So many changes were needed since that application. That URLA had not changed. God, I want to say since the 70s or 80s. So a lot of changes were made. I know a lot of people will say, "Wow, that's a lot of paperwork." That application, you're looking at, what, 16 to 20 pages of an application. So it is a lot.
Mhm.
But like Kasey said, it's a storybook. It kind of tells everything about that borrower and what they're wanting to do and what their job, their employment, their income. If they've ever had a bankruptcy, are you obligated to pay any child support? What properties you own? What any type of assets you have? It encompasses everything. So it is a lot of information, but you do need it because this is going to be the largest transaction in your life. A mortgage loan will always be the largest transaction in your life. The next item I'm going to run into, and this kind of comes up quite a bit. I'm going to go over a couple of things. One was closing costs, and I know Kasey and Janet, you get asked about closing costs. What are my closing costs? Who pays for closing costs? What are closing costs? Closing costs are the fees charged either by the lender or by third parties. When you're doing a mortgage loan, generally it has to be an appraisal, has to be done. Appraiser has to get paid for his work. That is a closing cost. Title company, and we'll go into more about what title companies do. But a title company does charge fees. They have to be paid. Those are closing costs. Any type of recording fees, state tax stamps, anything like that are third-party fees either by the county or the state that are charged. And your lender may charge an underwriting fee or a processing fee or an origination fee. Those are also fees too that encompass in the closing costs. What am I missing here, guys? Verification of employment. A lot of people don't know that their employer, in order for us to verify that they work there and how much money they make and the hours they work, to do a verification of employment, your employer is going to charge for that. Either they're going to charge for it because their HR has to do it and take time out of their day, or they use an independent third party that does the verifications for them. And I know I've seen verifications of employment be anywhere from $35 to $60. I think it's pretty much what you guys have seen as well. So do
Mhm.
be aware that there are costs involved doing a mortgage loan. Also, too, I want to mention this: who pays for the closing costs? There's two ways to pay for it. If you're buying a house, the seller could possibly pay for some of your closing costs, if not all of them, or you have to pay for your closing costs. So that's kind of, or it could be a gift too, a gift from a relative that could pay for your closing costs. Um, Down payment. We're going to go into this a little more detail. Down payment. Generally, when you're purchasing a home or land or investment property, there is a down payment requirement. However, your lender, TVFCU, we have a loan product that has no down payment requirement. So down payment is just something that your lender basically wants to make sure that you have some skin in the game. So depending on your credit or the type of property that you're wanting to do, or something like that, it's going to depend on how much down payment you want to put on there, if there's any down payment requirement at all. So down payment, that's a big deal too. A lot of people don't realize, based on my credit, or if I want this type of loan, whether FHA or standard conventional loan, it might require a down payment. And those funds generally have to be either your funds, or they can be a gift funds from another borrower, or they can be funds from some type of a down payment assistance program. Escrow. This one comes up quite a bit. A lot of people are familiar with escrow. Some people aren't familiar with escrow. What is an escrow? Escrow are funds that are paid on a monthly basis, generally with your payment, to pay your property taxes, your homeowner's insurance, any type of what am I missing here? PMI. You might have PMI in your loan if you don't put 20% down. Sometimes that's required on a standard conventional loan, or a homeowners association also too. So I'm a big fan of escrowing taxes and insurance. I think it's a smart thing to do. That way you don't have to pay your property taxes or your homeowner's insurance in bulk once per year. It just breaks it down in the monthly payment. And that way your taxes and insurance are paid. If you don't put 20% down, I'm going to tell you, escrows are going to be required regardless. That's pretty much every lender that I know of, TVFC included, if you don't put down 20%. And that's another fallacy too. Talking about down payments, a lot of people think you can't buy a home unless you put 20% down. There are so many programs out there. I know Kasey and Janet, FHA, USDA, even our programs here we keep on our portfolio don't require a 20% down payment. Same thing with Fannie Mae and Freddie Mac. That requirement's not there. However, some of those loan programs, if you don't put 20% down, you do have to carry the PMI. Next one, we'd already talked about what a mortgage originator does, and that's the first point of contact, as Janet was telling us. Once, let's just say, Janet, if you've already got my loan paperwork, and I've already signed my initial disclosures, and our loan is ready to start going in the
Mhm.
process, where does that loan go to now? You're the originator. You've already worked on it. You've got the full file. You've got all the pay stubs, W-2s, everything, all the paperwork we needed. What happens to that file next? Who does it go to?
Well, you will be assigned a processor, a mortgage processor. That's the next step. And the mortgage processor, they will make a nice, neat, tidy file to present to the underwriter. Um, he or she would make sure that all the documents are there, everything is signed. She or he will order the appraisal, the title work, but primarily it's making sure you meet the guidelines for the product, that all your documentation, supporting documents and required documents are there before handing it off to the underwriter. The underwriter, they need everything there to give a complete decision. Otherwise, it comes back to the processor and it slows us down. So it's very important when the processor communicates with me possibly, and I might need another document, that we're in this together. We're a team. So the applicant, myself, and the processor work together to make sure everything is there so we don't have any snags along the way, because when the underwriter gets it, they make a decision on what they've received.
Correct. And we'll get to this in a little while, but you were talking about the processor as far as the underwriter doing the decisioning.
Mm-hmm.
They do an initial look at the file when the
Mm-hmm.
title work and the appraisal were waiting on that to come back and verification of employment to see if there's anything else missing, because a lot of borrowers, and I've even had relatives of mine say, hey, I did a loan a few years ago with so and so, and they kept asking me for paperwork, and I kept sending the same paperwork, kept asking me and asking me. And I know, I'll give it one example. My relative said, well, I sent them my bank statements, but then they said that they need the last page of my bank statement, but there was nothing on it. And I said to
Oh.
my relative, I said, if it was 3 pages and the first page said 1 of 3 and the second page said 3 of 3 or 2 of 3, they don't know what that third page said because you didn't send it to them, even though it's blank. They don't know if it's blank or not. All they know is
Mm-hmm.
they have 2 of 3 pages and they don't have the third. So they're thinking, there's something missing and something I need to see, so that's, I was explaining to my relative, I was like, yeah, they had to have that. Or also too, the paperwork that is provided, sometimes once it's reviewed, it might raise another question. This bank statement showed us where did that money go to? Did it go to another? This was your down payment money, but it came from another account. It's showing on this statement. We're going to need documentation from that other account showing where it came from, because there has to be a paper trail on a lot of this. So I know it is paperwork intensive. That is the mortgage business. We here at TVFCU, we try to minimize as much as possible. But do be aware it's going to require some paperwork, and that's what the originator and the processor are doing in the initial part of it, is to anticipate everything that the underwriter is going to need to make a decision. But again,
Mm-hmm.
sometimes something might be missing, or it raises more questions, or if the title work comes back, or your verification of employment, or the appraisal comes back, it may require additional paperwork or to answer some of those questions that arise during the loan process. So
Mm-hmm.
just do be cognizant of that if you are going to be doing mortgage loan. Be aware, originator is going to try to get all that up front as much as possible, but it may require more documentation later on through the process. Um, Janet was mentioning about title companies. Kasey, why don't you kind of tell us about what a title search is, a title commitment, and closing through a title company? What does a title company do, and who are they?
Yeah, so your title company is going to carry out your closing for you. So Tennessee Valley is going to originate the loan, kind of carry you through that process. But then once it comes time for closing, that title company is really going to take over for you. Of course, we'll still be involved and be there for you, but they'll be kind of your next step in getting the loan wrapped up and closed. So they're going
Yeah.
to do everything from research the property, do a title search, and make sure that that property is, free of liens. An example could be, I get a new roof on my home, and, is there a lien on it? Well, that new owner wants to make sure that, there are no liens that are going to, still be present on the property, and that everything is satisfied with them going into it. And they're also going to draw up all of your closing documents for you in terms of the new deed being recorded, to ensure that we have the proper owners listed on there, and that everything is in line to be recorded then with the county, to make sure that we have everything correctly documented as we go into that final stage, which is ultimately getting you signed and getting the keys in your hand.
Yeah. And people don't realize sometimes, if you're going to be buying a property, you want to make sure there's nothing outstanding from the 1990s, 80s, 70s, 60s, 30s, 50s. I mean, there are things that have come up on title searches that have just, I mean, wow, I didn't really, didn't know. There can be small stuff. Sometimes if you get a hot water heater installed, they may put a lien on your property until that is paid off. Sometimes also a lender may have not, your loan may have been paid off with them, but the lien wasn't removed correctly. Either they didn't send in the lien release to the deeds office, or that deeds office may have made an error and not recorded something correctly. Sometimes when items come up from title searches, it can take a while to get them cleared. I know we've had some with our local title companies that take them a few days to get it cleared up. Sometimes, in some cases, take weeks to months of getting it cleared up. So just be aware that those issues do arise, and your originator won't know that in the very beginning, because we are using an independent third party, a title company, to do their work and ensure that we know what the current liens are. and making sure also too with TVFCU or any other mortgage lender that their lien position is correctly recorded as it should be, whether it's a first mortgage or a second mortgage or a home equity line of credit, second mortgage, something like that. So yeah, title companies, and also too, we use all the local title companies in this area for the most part. Have really good working relationships. I think Janet and Kasey can will nod your head that TVFC we are very popular among the local title companies since we do a very good job and try to be complete with our paperwork and our wires and everything. So you also mentioned Kasey about an appraisal. What is an appraisal? Why do I have to have an appraisal? And are there different types of an appraisal?
Yeah, so there's various different types of an appraisal. Your popular ones are going to be some lenders opt to use an electronic appraisal. So sometimes those can be used if the home value or information in the online system's been updated recently. If your loan to value, that just refers to how much is your loan versus how much is your home worth. If that is relatively low, a lot of times we can do an electronic appraisal, and that tends to speed up the process for you. Just because with how busy the market is, we do see a lot of our appraisers are getting pretty backed up, still getting them in a timely manner, but do have a log of reports that they have to get completed. Some will opt for an exterior only appraisal. This tended to be pretty popular during COVID. Main reason for the appraiser does not have to enter the home. So they can completely do the appraisal from the outside, as well as pull some of that online information that we talked about in terms of square footage, how many bedrooms, bathrooms do we have, to then complete their report. And then the third main...
And I know a lot of us in the industry, we refer to that type of appraisal as a quote drive-by appraisal. It's everybody uses that term drive-by appraisal, but it's also known as an exterior only appraisal.
Yeah, and then
go ahead. I'm sorry.
No, you're good. Our third main appraisal type is going to be a complete appraisal of the home. So they are going to call you to schedule a time to come out to the property. Many times, a lot of our homeowners will kind of prepare the property for an appraiser, whether that be, wrapping up any small projects that they have going on, cleaning the home, getting ready for that appraiser to come out and assess the value of it. Many times now the appraisers will ask you, to either be out of the property while they're doing that, just to avoid that contact, or turn on all the light switches so that way they don't have to touch anything while they're in the home. So definitely, whatever type of appraisal you're getting, make sure you're informed about that and know your rights. You always have a right to receive a copy of that appraisal. So you want to make sure that you're reviewing all of your documents, talking to your loan officer, and knowing what you're kind of getting into and what kind of report you're going to be receiving throughout the process.
Yeah, and that's very important because an appraiser is an independent third party. We're trying to gauge the value of the home. That is not doesn't work for TVFCU, doesn't work for the borrower, doesn't work for the realtor if there's a realtor involved. It's an independent assessment of what that property is worth. And I know, over the years looking at appraisals and how they do their work, I'm not an appraiser, but I know how to read an appraisal. I know many of the local appraisers. And it is an opinion, but it's also opinion based on data and information taken from MLS. They have to use comparables to compare your home to. Sometimes, especially if you go out in a rural area, it's a little bit more difficult to find comparables. So that's an issue. Or if it's a unique property like a berm home or an A-frame home or something like that, it gets a little bit tougher. And especially if you're using homes like barn dominiums. There's all kinds of different types of homes people live in these days. But yes, an appraisal is an independent third party that we use. Also, too, something that's changed over the years because of what happened, years before in the mortgage meltdown. Appraisers have to be independent. We cannot talk to them about value or anything like to do undue influence on their appraisal. So a lot of borrowers sometimes may get upset that the value didn't come in. for what they were hoping for, especially if it's on refinance, but sometimes on a purchase too. We're not quite seeing that as much because values have gone up quite a bit, but it does depend on the area, the type of home, the age and condition too. Of the home. I could almost do a whole thing just on appraisals, which we may do one day, bring an appraiser in and talk about some of these things. But appraisals are a big deal. And like Kasey said, you do get a copy of your appraisal. Another thing too that TVFCU is doing right now, this is our special for 2022, is we pay for your appraisal. So whether it's a full interior, exterior appraisal, or if it's next year only, we pay for that, the cost of that appraisal. So do your loan for TVFCU. Next one, Janet, you had kind of mentioned this earlier when talking about an originator and talking about a mortgage processor, but you had mentioned a mortgage underwriter. Tell everybody out there what a mortgage underwriter is, and what they do, and why they are so important.
Well, that is really one of the main reasons it's so important in being forthcoming and providing all the correct documentation, because the processor who will hand your file off to the underwriter, is the one that's going to ultimately approve or deny or possibly counteroffer your loan application. And that is going to be based on the information that we've provided and verified, such as assets, your credit, your employment, the income documents, the type of loan. Are we meeting the guidelines for that type of loan? And that's what the underwriter does. She or he decides, based on the information that we've provided, do they qualify for that loan? And it often seems very strict, and there's a reason. This is your home. We can't take any risk that we are going to put you in a home that you can't afford and you're going to struggle. It's not like buying a car that you could just resell quickly. This is your home. And so the government has provided strict guidelines. The underwriter has guidelines, and it's for your protection, to make sure that we get you in a home that you can afford. That's the bottom line. And they have the final decision.
Yeah, they do. Originators are they're experts at trying to get you into a program that they could possibly get you qualified for. But that final decision is not done until all the paperwork is in, all the verifications are in, appraisal, title work, and everything like that. Like I always tell everybody, it's not done until it's done, and your loan is at closing, and you have signed on the dotted line. So just everybody, be aware that it is a process. Generally, it's about a 30-day process, sometimes a little bit longer, sometimes a little bit shorter. But during that process, anything that you put on that application, the URLA 1003, whatever you call it, we have to verify it. And Janet had mentioned you want to be honest and forthright on your application, because anything that you lie about is potential mortgage fraud. So do not do that. Be as honest as you can with your originator about your application and what you're wanting to do, because we don't want anybody getting in trouble. We don't want to get in trouble. We don't want you getting in trouble. And mortgage fraud they do prosecute for that. So make sure you're being honest. Also, too, as an originator, we are your advocate. We're going to try to get you from point A to point B. We're going to try to get you your goal of owning a home or refinancing. And sometimes you may not be in a position to right now. Your credit may have issues. Your income may have issues. We're going to let you know, hey, right now is not the best time, and you possibly wouldn't get qualified. But if you do this, and this, we can get you to a point where we can get you qualified and closed. So do understand that, that originators have a certain role, mortgage processors have a certain role, and a mortgage underwriter has a certain role. A mortgage underwriter, it has the final say so, and does go by the guidelines like Janet was saying, whether it be Fannie Mae, Freddie Mac, or if you're doing an FHA loan or a VA loan, or you're doing a portfolio loan through your local lender, they're going to have an underwriter who's going to underwrite that loan and make sure everything matches the program that the borrower has applied for. So Kasey, we were talking about mortgage underwriting. What does an underwriter do, basically? When they get the file, what are they doing?
Yeah, so really with your underwriter, you're going to be visiting them 2 times throughout your loan process. Your first one is going to be going into your initial underwrite. or, your initial conditioning of the file. So that underwriter, once receiving the file from the processor, is then going to review it to make sure, if a self-employed borrower is on that application, did we calculate that income correctly? They're going to review things like the current deed on the property. Are both borrowers that are currently owners of this property on this application? Perhaps is one of our borrowers married? And sometimes in the state of Tennessee, depending on the title company that you use and some of the local laws, your spouse, if you're legally married, has to be on that deed and title work to the home. So they're going just to make sure that that application, once going through originating and processing, is clean, is solid. They're going to review it and then initially decision it for us or condition for any documentation. So that may be why you're getting an email from your originator or processor, requesting additional documents. And then the second time you're going to visit that underwriter is going into what we call your final underwrite and get ready for closing. So that'll be once we've received that appraisal back, once we've received all of that title work, they're going to review all of the documents in the file. Like Janet was saying, again, verify that this is something that our member can afford and we're not stretching them too thin throughout this process. And they will be the ones that ultimately give you the final decision on if we can enter into closing and get you your date and time to then sign on that dotted line.
Yeah. And it is a process, like Kasey said, and you have your initial underwrite, which is when the processor receives the file, has gone through it. We have most everything there except for maybe the title work, appraisal, maybe verifications of employment, and we may be missing a couple of items of paperwork that they didn't get to us, but were enough to where the underwriter can make a conditional approval, or I may have to do a counteroffer sometimes. And then once they get all that back, then it goes to the final, to the underwriter. They have everything they need. Everything's there. There are no more questions. They've signed off on it. They have put their name on the dotted line. So that underwriter, they are responsible for that file. They're responsible for making that decision on that file. And just to let everybody know, lenders do get audited too. And sometimes they'll pull files and they'll question, why did you approve this one? It didn't quite meet, this guideline. Was there something that you have, an explanation on that? So just be aware that there are guidelines that companies have to abide by, whether their own internal guidelines or it's Fannie Mae, Freddie Mac, FHA, VA, anything like that. They do have to adhere to those rules and those guidelines. That's going to lead me to my next thing. Once I have my loan approved, it is the underwriter has signed off on it, and it's in the industry what we call CTC, clear to close. That means that loan has been approved. It's ready to go to closing. What does a mortgage closer do at TVFCU?
Okay, well, once your file has, like Bryan said, has been through all the steps, we're ready to close, the mortgage closer will work with the title company in preparing a closing date and a closing schedule. The mortgage closer will prepare a document, often called a closing disclosure or CD, that they will send to the borrower to review and approve. And that will have the final numbers. So you won't have any surprises at the time of closing. It helps you know the funds that you're going to need to send to closing via wire or cashier's check, however, that would be discussed with you. But they work with the title company to balance all the numbers, make sure everything, matches, that you're okay with you can review rate, term, payment, escrow. It's your time to review that final document for what you're going to be signing at closing. Then once that's all good, they will send the title package or closing package to the title company. And then the title company will, once you appear at closing, you will have a title company closer. That's where you sit around the big round table and get writer's cramp because you are going to sign and sign and sign some more. And that's a time to ask questions. If you look at something and you have no idea what you're signing, ask a question. And I've had situations where questions come up, the title company will call me and
Yeah.
we can discuss it. But hopefully all questions have been answered prior to that. That's our goal. We don't want any last minute, lack of information. That's why we try to stay in good communication with you throughout the process so you don't have any surprises or questions. But the mortgage closer and the title closer work together for that great day when they hand you the keys.
Yeah. And it also mentioned, and we were talking about closing and purchases and refi, and I'll answer this part here. Purchase and refinance. There are some differences in timelines. You were talking about the closing and disclosure, the CD,
Mm-hmm.
that has to
Mm-hmm.
reach the borrower and has to be signed 3 days prior to closing. So that's very, very important as a federal law. It's not really anything you can get around. You have to have that closing disclosure with the final numbers in front of you at least 3 days prior to closing. And then the documents you sign at closing, I know when you initially apply, your originator will give you initial documents. When you get those initial documents, make sure you look through those and ask your originator if you have any questions about that, because a lot of those documents are going to be the same documents at closing too. So if you're already aware of what those documents mean, your fees or charges and stuff like that, that's going to be in your initial documents. Ask your originator if you have questions, because it's going to make things flow later on better. And also to timeline, we were talking about the CD, you have to receive that 3 days prior to closing. On a purchase and a refinance, there are some timelines when the loan goes into effect. On a purchase, whether it be your primary residence or you're buying investment property or you're buying land, once you sign those documents, it's done. Congratulations, you own that property now. However, on a refinance on your primary residence, there is a thing called a 3-day right of rescission. That is a law. It is a requirement. If you're refinancing, say if I'm refinancing my home either to get a better rate or get some cash out, I sign those documents. I have to wait 3 days to make sure I want to do that loan, because the government gives me the option of, after that, within that 3 days, if I want to back out of that loan, I can, quote, rescind. I can back out at no cost to me. Reason they do that is because it's your primary home. They want to make sure what you're doing, the refinance, is something that you want to do. And they give you that 3-day window there to back out of it at no cost to you if you want to. So please be aware of that. If you're doing a refinance, whether it be a home equity line of credit, be a second mortgage, or if it's a first mortgage on your primary residence, there is a 3-day right of rescission requirement from the federal government that generally cannot be waived. There are some very, very specific circumstances it can be waived, but those are very, very few and far between. In my 25 years in the business, I don't think I've ever seen one. Well, one I saw back in 1999 got waived, but it's very, very rare. So just, if you need that money to put in a pool and you've got a contractor sit there waiting, make sure that timeline includes that 3-day right of rescission. Okay. People have asked me well, what about, if I'm refinancing an investment property? Nope, there's no right of rescission. Once you sign those documents, it's done. Okay. The government only requires that on your primary residence, since it is the home that you live in, it's your roof over your head. They want to make sure that's what you want to do. Okay. So that's kind of going through some of the key terms. So next, few minutes, next 5 minutes or so, we're going to take a few questions here that you've already submitted to us. I'm going to read these out, and Kasey or Janet, help me answer some of these. Let's see here. Is this even a good time to buy a home? Janet, throw in your 2 cents there. What you think?
Yes. I know you hear on the news rates are going up, and they have gone up some. They are historically low. I know we kind of toss that phrase around. We were just really, it was uncanny how low they got, but that was just a pass. That was just a short period of time. Think of a home as a home. You don't want to have to rent. Rent has gone through the roof, I've heard. For less money that you pay on rent, you could be owning a home and building up a strong asset. You're going to build up asset base quicker in owning a home than having money in the bank right now. Rates are a little bit higher. They're still good. Relatively speaking, they're still good. So the longer you wait, it could go higher. We don't know. And if you watch the news, you really don't know. But it is a good time to buy a home. Just
Yeah, yeah.
It's just a
If you
good
could
feeling to
find
own your own property.
yeah, the inventory is still low. Builders are building as quickly as they can. Hopefully, inventory will loosen up here the next 6 to 12, 24 months. But it is, like I said, rates are still competitively low historically. I know when I came in the business in the late 90s, the best rate you could get was 8.5, 8.25. And right now
Mhm.
we're hovering around, 5 1/8, right around there, 5.25, maybe around 5% on a 30-year fixed. So rates still are very good. Um, Janet, how long does the pre-approval process take? Say, I want to get pre-qualified because I'm wanting to go look at a home. I'm in my
Mhm.
rent's too high where I'm renting, and I really looking at buying a home.
If it's not a complicated situation, I mean, if it's, just regular W-2 employee, you've got the assets, nothing unusual, um, we can pre-qualify you in a day or
Yeah,
a couple of hours. The
yeah,
originators do that. That's what we do. And if it gets a little tedious, if you've got lots of LLCs and corporations and this and that, it might take a couple of days, realistically. But
yeah,
typically, that same day, and we can
yeah.
email you the pre-qualification letter, and
Hmm.
I mean, we can jump right on it quickly, especially if you found a house, because it is a seller's market and houses are flying off the shelves, so you want to be ready. So if you
Yeah,
notify us, say, hey, we're making an offer on this house, get with us ASAP, and we'll help you get pre-qualified as quickly as possible.
yeah. And I know too. You were talking about LLCs, and if it's a complicated loan scenario, if there's some issues, that's where it goes back to your application being as honest and upfront with us as possible,
Mhm. Mhm.
because at the pre-qualification process you're not verifying anything. That comes with the loan process later on. So it's very important that if you put on your application, hey, I work for so and so corporation, I get paid a W-2, this is my base salary, or this is what I make hourly. Being honest with us about your income, your debts, your assets. That's very, very important, because the more honest and upfront you are with us and detailed on your application, that's going to help us with your pre-qualification. Because remember, what's on that application, we have to verify it. Okay.
Mhm.
And we've had over the years, especially like someone self-employed. Yes, I make $80,000 a year, but once we get your tax returns, you see it. They write off a lot of things. Their gross receipts may say 80,000, but once their write-offs, the net may show $15,000 a year. So that's something we do.
Mhm.
Every mortgage lender, all my friends that are competitors, we all talk about this. That's something you do run into. So and that's something a good originator is going to ask. Hey, I see you're self-employed. Is this what do you write off? What's this? They're going to ask those questions, and please be honest with them, because we need to know that. We need to know.
Mhm.
Um, that leads me to my next one. There's another question that was asked, and Casey, if you'll answer this one, how do I need to have? How much do I need to have saved for a down payment?
Yeah, so that's really where your mortgage originator is going to come in and kind of guide and assist you throughout that process. Some loans, according to Fannie Mae and Freddie Mac, require 3 to 5% down as a minimum requirement. Or some of your local lenders, like Tennessee Valley, offer amazing products with up to 100% financing. So that's when, you're having that initial conversation. You've had your application placed, and we are reviewing all factors, like your debt to income ratio. How much am I spending monthly compared to how much am I bringing in? Your credit score. And a big fear people have is we just strictly go off of that score number. Well, we also take into account your positive payment history. You know, do we have any collection accounts reporting? Do we have late payments? And, if we do, how old are they? So a lot of those, fears or misconceptions of, I don't have a good credit score. That doesn't necessarily mean you have to put a huge amount of money down. Home buying can still be affordable for you. And I think me, Janet, and Bryan can all attest to the fact of Tennessee Valley can do some really cool things when it comes to, what we can offer to our members. So, definitely don't be afraid to ask those questions. We're all nice here, whether you're meeting with us face to face or through the phone. We definitely don't mind answering those questions for you and kind of making sure you're comfortable with the whole process.
Yeah, and there's people sometimes, and I do get this from friends and competitors. They only do USDA or THDA or Fannie Mae or Freddie Mac or VA. There's so many products out there. Plus your local lender that has their own products like we do. We do the Freddie Mac loans too, secondary market like everybody else. But we also have our internal loans that we do or our portfolio. Like you were saying, no money down, 100% financing, no PMI requirement. It's a great product, very, very popular. So yeah, talk to your lender and see what's available. Don't just be stuck if somebody said, "Oh, you just need an FHA loan." No, not necessarily. The FHA is good, but there are other products out there too. So that's where originators, your mortgage originators like Kasey and Janet come along. They're gonna let you know what is available and what we have available, and what might be best for you. We're going to try to knock out a couple more questions, and we're going to wrap things up because we do have a drawing coming up, and we're going to be drawing from one of our viewers for a gift card. Janet, how big does a low score impact your ability to obtain a home loan? I know you kind of talked about this before, but if you have a low score, what are your options? What do you need to do?
Well, I will be honest, and the lower your credit score, the more work you may have to do. It may require a larger down payment because credit score is a pretty big driving factor in home ownership. Now, so do be prepared to talk with your originator once credit is pulled and we determine what caused the credit score to be low. We can help guide you on maybe what you need to do, maybe pay down some debt. But what I tell my members are, if you've got some work to do on your credit, because life happens and we know that, there's no judgment whatsoever on a credit score because life happens. But we do want you to be able to get a home that you want. So work on your credit score. You are allowed to pull a free credit report annually from annualcreditreport.com and look at your credit, do some homework, save, because when you're buying a home, you can't be guaranteed you're going to get 100% financing. You can't be guaranteed the seller's going to help you with closing costs. So if you have a low score, it's going to take some homework on your part. We can guide you. We can't do it for you, but you can at least see what steps you need to do, because it will help you in the long run to get a better house. Yeah.
We had, and I get this all the time because I talk to, you, my staff, and other originators. We had one time they came to us. The credit score was not that great. They had already talked to another lender. They either couldn't do anything for them. They required 20% down. We were able to do it with only 10% down, but the borrower said, I really like your no money down, your 100% financing. I'm going to work on my credit. So they worked on their credit. I think it was 6 months later, they came back, cleared up a lot of things, paid some things off, got some things taken off there that shouldn't have been on there, or they were collections or something like that. And they brought their credit scores up, and they qualified for no money down. So even though they could qualify for something, they may want to do a little work to where they qualify for something better, maybe a better rate or better terms or something like that. That's something too. You definitely want to look at your credit and see where you stand. Let's knock out another question here real quick. Kasey, I want to ask you this one. Where do you start the process? How to get the ball rolling? If I'm thinking about purchasing or refinancing, what do I need to do?
Yeah, so once you are ready to get that process started, I always tell all of my members, especially my first-time home buyers, to research the area that you want to live in. I just recently bought a home in the Chattanooga area as well, and one of my requirements was 3 bedrooms. and at least 2 bathrooms. So what am I going to do? I'm going to hop online, see, okay, in this area that I want to live in, 3 beds, 2 baths, what are homes in that area kind of going for? So I know once I talk to my originator, hey, this is around the budget that I really need, because homes that, meet sort of my requirements or my guidelines, that is kind of what they're starting at. So that at least gives
Mhm.
your originator a starting point to see, where we can get you pre-qualified at, kind of know what you're comfortable with paying monthly. Um, Again, you don't want to stretch yourself too thin, and that is something that we can help you with in terms of your estimated monthly payment. Um, and know the areas, so the big things are just, how much are you comfortable with paying monthly? What are sort of your requirements for the home that you're looking for? And then, am I in an area that I'm ultimately going to be happy in? Because you are making that commitment of home ownership. And then once we've kind of addressed all of those three, we're then going to, kind of get the ball rolling with that application that we went over, building our story in our portfolio, and ultimately, getting that pre-approval letter to then contact a realtor and start seeing these homes. The fun really kind of then begins when you get to walk into these homes and picture, hey, this is going to be my bedroom, or this is my backyard where I can grill
Yeah.
at. That's where the real fun begins.
Yeah, yeah. And you mentioned realtor, and just want to throw a plug in there. We have some really great realtors in the Chattanooga area. We work with all of them, have good working relationships with them. The Chattanooga area realtors, the Women's Council of Realtors. Those are great groups here in Chattanooga. So I highly recommend, if you're looking to buy a home or some land, make sure you're working with a good lender or a realtor, and a lender, but a realtor is
Mhm.
very important. They're going to walk you through that process too, and work with your originator too. Kasey and Janet, I know you work with several realtors here in the locally, in Chattanooga, Tennessee, North Georgia area. So I do highly recommend working with a good realtor. Really do that, especially in this market. You'd be almost lost without it. So we're going to go ahead and wrap it up. Time's a ticking here. We I'd like to cover a lot more, but I'm going to have Kasey and Janet back with me another time, and we'll cover some more information. I think we do have a winner on our drawing. There is Tanika Riggins. Congratulations, you have won a $100 Visa gift card. I'm going to be reaching out to you, and we're going to get that to you here hopefully next day or two. So Tanika, congratulations on the drawing and winning. Also, we're going to put up some contact information here for Kasey and Janet, and for Tennessee Valley Federal Credit Union. If you want to reach us, our main number there, 423-634-3667, or mortgage.support@tvfcu.com. Kasey, go ahead and give me your contact information there.
Yeah, so you can reach out to me at any time. Phone number 423-634-3697. You can also shoot me an email at casey.lewis@tvfcu.com, or visit our website, tvfcu.com/Kasey Lewis. That'll take you to my mortgage page, and I'll be more than happy to assist with any of your needs.
Okay, and Janet, give us a little bit of your contact information.
Yeah, my direct phone number is area code 423-634-3654. And email would be janet.sherman@tvfcu.com. And again, as with Kasey, you can go to our main website, tvfcu.com, and /Janet Sherman. So you can find
And
us that way.
those links right there, those will take you directly to Kasey and Janet. If you want to apply with them directly, go there to their website and then apply with them directly if you'd like. Again, thank you everyone for joining us today. Kasey and Janet, thank you for joining me. We kind of run over in our time a little bit, but there's a lot of good information we covered here. Again, going to have you back. Thank you. Everybody have a great weekend. Please, Memorial Day weekend, remember all those that gave the ultimate sacrifice, and remember those on Memorial Day. Everybody have a great weekend. Thank you for joining us. Bye.